In this video, we're diving into credit spreads, specifically credit put spreads. If you're new to options trading, the strategy might sound a little intimidating, but I promise you it's one of the most straightforward ways to trade. And the best part, you only need $50 to $100 to get started, which is great for all account sizes. So let's break this down step by step. Trading credit spreads is a lot like placing a well-calculated bet on a stock. Why? Because you're picking a specific price and essentially saying, I don't think the stock will fall below this level by a certain date. If you're right, you win. If you're wrong, you lose. It's that simple. Now, obviously, we need to start with selecting a stock to run this strategy on. Now, this is entirely up to you, but I recommend focusing on stocks that are popular and highly liquid. Why? Well, liquid stocks give you better pricing because the bid-ask spreads are tighter, which means less slippage when entering or exiting the trade. Personally, I like to stick to stocks I'm familiar with, ones included in the S&P 500, because they tend to be stable and widely traded. But here's the real key. Look for stocks that are nearing a strong level of support or resistance. These levels give you an edge because they can help you pick more favorable strike prices to maximize your odds of success. Now let's jump over to movement really quick and see if we could find a stock that meets these criteria. Now at this moment, Nvidia has pulled back nicely, so let's take a look at that chart. Now let's add a few indicators here. You can use whatever you like, but I personally like to use the moving average and the Bollinger Bands. And if we zoom in here, you'll see that Nvidia is approaching the lower Bollinger Band, and in the past it hasn't stayed here for long. This gives me confidence that Nvidia will hold this ground and not drop below $132 in the short term. So that's where I want to place my bet. Let's jump back over to Robinhood and pull up the option chain on Nvidia. Remember, I believe Nvidia will stay above $132, so I want to sell a put option. So make sure you have the sell and put tabs selected. We also need to pick the expiration date. For this strategy, I like to keep with the weeklies as it tends to give me a quicker turnaround and lets me reevaluate the stock more frequently. So I'll stick with the 12/20 expiration, just 1 week out. However, if you want to be more hands-off, you could choose a longer time frame, like a month or even 45 days out if you prefer. Just note that with credit spreads, the plan is to typically hold until expiration, since that's when you can capture the full premium. As I mentioned earlier, I'm interested in the 32 strike put because I'm betting that the stock won't drop below this price before Friday. Now, if you're used to selling cash secured puts, you might think that we just sell this option outright and collect around $200 in premium. But here's the catch. To sell a cash secured put, you need $13,200 in cash to cover this specific position because that's the cost of buying 100 shares at the strike price of 132. But that's not what we're doing here. With a credit spread, you get to control how much collateral you want to put up front for this trade. Think of it as deciding how much you're willing to bet that the stock won't drop below $132. This way, instead of needing thousands of dollars in cash, you can open up the position with just a couple $100s, while still collecting premium and keeping your risk defined. So let's further break down what defines the risk and what defines the premium, or your winnings if we stick with this betting analogy. First, the risk is determined by the put option you buy as protection. So let's switch over to the buy and the put tabs really quick to see this. The risk is simply the width of the spread multiplied by 100. For example, if I sell the 132 put and buy the 131 put, that's a $1 difference in strike prices, or a $1 wide spread. Multiply that by 100 and my maximum risk is $100. If instead I bought the 129 put as protection, the spread becomes $3 wide, meaning I'd be risking $300. So the wider the spread, the higher the risk, but potentially the higher reward as well. Now let's calculate the premium, or the payout. This comes from the difference between the premium you collected for selling the higher strike put and what you pay for the lower strike put. For example, I'm selling the 132 put and I collected $203 for that. But if I bought the 131 put for $168, the difference is $35. That's the premium, or the payout. And we get this upfront, we're locking it in, while risking $100 in collateral. So in this case, you're risking $100 to potentially win $35. And lucky for us, we don't need to be doing this math in our head every time. Robinhood does this for you when you go to review the order, and we can see that by clicking the arrow at the bottom right. And here we can see what we just went through. We're selling a 132 strike put for $203 while buying the 131 for $168, meaning we're getting a total of $35 of credit up front. We can expand the P&L view and see just how defined this trade is. Our max profit is $35, and we know that we're using $100 of collateral to enter this trade, meaning our max loss is $65 because we get the $35 no matter what. So if we were to lose the full collateral plus the $35 we got to open it, that gives us a max loss of $65. Now that we've defined everything, let's look at how this trade would play out. If NVIDIA stays above $132 by expiration, our collateral is released, and we get to keep the 35 credit as pure profit. That's a 35% return in just 1 week. Pretty solid, right? But what happens if we're wrong and NVIDIA jumps below $132? Well, that's where we'll start to see a loss. If the price falls below 131, we hit our maximum loss. No matter how far the stock actually drops, even if it goes all the way down to like $90, we'll still only lose the $65 difference between our collateral and the premium we collected. That's the benefit of having defined risk with credit spreads. Now, technically, there is a break-even point between the max profit and max loss, but I wouldn't focus on this too much. Why? Because those in-between values assume that the options are exercised, which brokers like Robinhood and others typically don't allow due to their risk management policies. So here's the bottom line. Treat this trade as a win if NVIDIA stays above 132 by expiration and a loss if it drops below 132 by the closing bell. It's worth noting that credit spreads require active management. That's just the nature of trades with such high potential returns. They can move in your favor or against you pretty quickly. Because of this, it's important to have a plan in place. Decide ahead of time where you want to take profits and where you're willing to settle for losses. Managing these trades with discipline is key to long-term success. So drop a comment if you want me to go over managing these positions in detail. But otherwise, please hit that like button and subscribe if you found this video helpful. It means a lot. Happy trading.